You've tracked every latte and stuck to your budget, yet your savings look grim. Meanwhile, someone else just bought their second rental property. What do they know that you don't? They stopped playing checkers and started playing chess with their money. Today, we're showing you the moves that turn confusion into compounding wealth. We're not just talking about saving pennies, we're talking about understanding how money works so you can make it work for you. 1. The checkers illusion. Most advice stops at spend less than you earn. That's checkers, simple, predictable, and not enough. Real wealth is three-dimensional chess. You need to see the whole board: time, risk, inflation, leverage, all at once. The illusion is that basic budgeting is the key. The reality is, it's just the entry fee. To actually win, you need to understand the deeper game. 2. Time value of money, the invisible wind. Time is literally money. $1 today is worth more than $1 tomorrow because it can be invested and earn more. That's the time value of money, or TVM. Ignore it, and your long-term goals will slip away. For example, if you invest $1,000 at an 8% annual return, it doubles in about 9 years without you lifting a finger. That's compound interest. But if you wait 9 years to start, you'll need to invest $2,000 just to catch up. This isn't magic. It's compounding doing the work while you sleep. On the flip side, this same engine powers debt. If you owe 20% on a credit card, interest starts earning interest, and a small purchase becomes a big regret. The cheat code to wealth is to start early and give your money enough time to grow exponentially. Wealth isn't built in days, it's built in decades. 3. Risk isn't a storm, it's the ocean. Most people think risk is a storm to be avoided, but risk isn't the storm. It's the entire ocean you're sailing on. You can't avoid it, but you can learn to navigate it. Risk and return share a seesaw. Higher returns usually require taking on more risk. But risk isn't random. It's measurable. Tools like standard deviation show how wildly an investment's price swings. Beta tells you how much an investment moves relative to the market. A stock with a beta of 1.5 moves 50% more than the market index. Great in a bull market, brutal in a bear market. So how do you navigate this ocean? Diversification. It's your life vest. Spreading your investments across different asset classes, sectors, and geographies means if one part of your portfolio struggles, another part might be thriving. A well-diversified portfolio can smooth out the ride over the long term. 4. Asset valuation, the art of not overpaying. You wouldn't buy a beat-up car for the price of a luxury sedan. That's because you instinctively understand value. In finance, asset valuation is the art of figuring out what an asset's future cash flow is worth today, so you don't overpay. The gold standard is the discounted cash flow model. This involves projecting future cash flow, then discounting it back to its present value. You sum up these values to get an intrinsic value. If the market price is lower, you have a margin of safety, a cushion. If it's higher, you walk away. For quicker checks, investors use the price-to-earnings, P/E ratio, which tells you how much you're paying for each dollar of a company's earnings. Is a P/E of 15 good? It depends. The P/E is a snapshot. The DCF is the full medical report. Understanding valuation means you're not just following a trend, you're buying a future cash flow stream at a good price. 5. Inflation, the silent tapeworm. Inflation is when your money slowly, quietly gets less valuable. Your $5 bill is still $5, but it buys less than it used to. It's a silent tapeworm eating your purchasing power. What causes it? Sometimes it's too much money chasing too few goods, known as demand-pull inflation. Other times, rising production costs get passed on to consumers, which is cost-push inflation. Even the expectation of rising prices can cause them to rise. Historically, inflation has averaged around 3.8% since 1960. At that rate, $50,000 of today's purchasing power shrinks to just $23,000 in 20 years. Your investments aren't just trying to grow, they're trying to outrun this tapeworm. Stocks have historically returned 7 to 10% after inflation, while cash returns close to zero. This means long-term money belongs in assets that can outpace inflation, like stocks. Short-term money belongs in high-yield savings or treasury bills. 6. Liquidity, the escape hatch. Liquidity is how fast you can convert an asset into cash without selling it at a huge discount. It's your financial escape hatch. Your checking account is highly liquid. Your investment in a friend's startup is not. Why does this matter? Life happens. A car breaks down, a roof leaks. If all your money is tied up in illiquid assets like real estate, you might be forced to sell a great investment at a terrible price just to get cash now. The rule of thumb is to keep 3 to 6 months of living expenses in a highly liquid emergency fund, like a high-yield savings account. This is your buffer. Once that bucket is full, your other money can go into less liquid investments like real estate or private equity, which often offer higher returns precisely because your money is tied up. It's a trade-off, and understanding it keeps you prepared, not panicked. 7. Financial ratios, the business MRI. Financial ratios are like an MRI for a business. They diagnose health and spot problems long before the headlines. Here are 5 vital signs to know. Return on investment, ROI. This is the bang for your buck. If you put in $100 and get $120 back, your ROI is 20%. It measures how efficiently an investment generates profit. Working capital. This is current assets minus current liabilities. Positive working capital means you have enough short-term assets to cover your short-term debts. Negative means you could face a cash crunch. Net margin. This shows what percentage of a sales dollar becomes profit after all expenses are paid. A 10% net margin means for every $100 in sales, $10 is profit. Debt to equity ratio. This shows how much leverage a business is using by comparing total debt to owner's equity. A high ratio can amplify gains but also amplify losses, signaling risk. Price to earnings, PE, ratio. Market price per share divided by earnings per share. It shows what investors will pay for $1 of earnings and can signal if a stock is overvalued or undervalued. Memorize these 5, and you'll be able to spot opportunities and risks like a pro. 8. Good debt versus bad debt, the double-edged sword. Debt isn't inherently evil. It's a double-edged sword. It can build wealth or dig you into a hole. The key is knowing good debt from bad debt. Bad debt buys depreciating items. Think of a new car that loses value instantly, or anything you put on a high-interest credit card. This debt works against you, draining your future earnings. Good debt, on the other hand, buys assets that appreciate or generate income. For example, a mortgage on a rental property where the rent covers the cost and then some, or a student loan that leads to a higher salary. The test is this: does the asset you're buying with debt generate more value than the cost of the debt itself? If yes, that debt is working for you. It's strategic leverage. Make sure you're the one benefiting from the interest, not just paying it. 9. Market cycles, the emotional pendulum. The market is an emotional pendulum, swinging between euphoria and despair, boom and bust. Understanding these market cycles is like having a map. Bull markets climb a wall of worry, starting when things look bleak. Bear markets slide down a slope of hope, starting when things look good but reality is about to hit. How do you know where you are in the cycle? Watch valuations and sentiment, not headlines. When your Uber driver is giving you stock tips and P/E ratios are sky high, euphoria is peaking. That's a signal for caution. Conversely, when headlines scream doom and everyone is selling, that's when you should be looking for opportunities. The crowd is almost always wrong at the extreme tops and bottoms. Your job is to be a calm contrarian. When others are panicking, you're looking to buy. When they're euphoric, you're taking some profits. It's about managing your emotions, not letting them manage your money. 10. The 5-step chessboard blueprint. So you understand the concepts. Here's your 5-step blueprint to play the game. 1. Automate a 20% investing rate. This is a non-negotiable rule. Before you pay any bills, 20% of your income goes straight to your investments. Pay yourself first. By automating it, you build wealth without needing willpower. 2. Fill your emergency bucket, then invest in low-cost index funds. First, build an emergency fund with 3 to 6 months of living expenses in a high-yield savings account. Once that's full, every extra dollar goes into diversified, low-cost index funds until you've saved 25 times your annual expenses. That's the financial independence number. 3. Layer in asymmetric bets with no more than 10% of your net worth. Once your foundation is solid, you can make speculative bets where the upside is huge, but the downside is limited to your initial investment. Think individual stocks, REITs, or small crypto allocation, but never risk more than 10% of your net worth on these. 4. Rebalance yearly. Once a year, review your portfolio, sell some of the investments that have grown excessively, and buy more of those that have underperformed. This enforces a buy low, sell high discipline and manages your risk. 5. Keep learning. Finance evolves. The tactics might change, but the fundamental concepts, time value of money, risk, valuation, inflation, are forever. Stay curious and keep expanding your knowledge. Pause the video and drop your biggest aha moment in the comments. I want to know what clicked. Then hit subscribe so you don't miss our next video. And if this helped, share it with one friend who needs to start playing chess with their money. We started with the frustration of playing checkers with your finances and feeling stuck. Now, you've seen the hidden levers of the real game: the time value of money, risk, asset valuation, inflation, liquidity, and leverage. These aren't just concepts, they are the rules of engagement. When you master them, you're no longer a piece on the board being pushed around by invisible forces. You become the player, strategically shaping your financial destiny. The next move is yours.